Hello and welcome to 1492 Capital Management's ongoing web video series. My name is Joe Frohna and I'm the lead portfolio manager here on our small cap growth product. Thanks for tuning in once again. Today's topic is valuation, and more specifically, how do we value small cap growth stocks here at 1492? Valuation is really the last in the series of processes we take before we put a stock into our portfolios. It follows our whole primary research and fundamental research efforts, where we're assessing whether a company has a strong enough tailwind to their business to meet the sort of growth requirements that we're looking for, namely a 20% growth rate in the top and bottom line of a company over the next 12 to 18 months. I always like to say that valuation is turning art into science. And what do I mean by that? What I mean is that there's really no right answer to valuation. It moves and changes each and every day as the stock market moves up and down, driven by such things as interest rates, changes in a company's fundamentals, and changes in sentiment. So we take a multi-pronged approach to valuation using three specific metrics. The first of these is industry specific. And what we try to do here is put ourselves in the position of a private equity firm or a company within the industry that we're looking at and say, what have those companies historically paid for companies within this particular industry? What multiples have they paid? And we use that as a proxy for an industry-specific metric. The second metric we use are earnings-based metrics. Wall Street has historically used price-earnings ratio as their earnings-based metric. We choose to use enterprise value to EBITDA. And why do we use that? It encapsulates a company's balance sheet, which is obviously very critical in today's world. So enterprise value is really defined as a company's market capitalization plus the company's debt on their balance sheet less cash on their balance sheet. And we look at what the cash flows that balance sheet can generate. So enterprise value to EBITDA, and then we come up with a multiple that we feel is applicable for that particular company's growth rate and apply it to come up with a valuation target. Lastly is what we call a cash flow metric, a discounted cash flow calculation or free cash flow yield, for example. Each of the three metrics that I've mentioned here are going to generate a value number. They're not going to be identical, but they'll generally be within a relevant range of each other. And without giving prejudice to one over another, we'll plot the target price in the middle of those three. As long as the stock has more than a 35% or more upside relative to today's stock price, it's a candidate to be purchased into our portfolio. Once the stock is put into the portfolio, each and every day we're monitoring that stock's progress to the valuation target. And once a company's stock price goes through our valuation target, it's generally sold at that point in time. It's a discipline we feel is critical to keeping us out of trouble when markets are very choppy, and it's a discipline that's worked historically through time. We'd love to discuss this more with you in the future. If you have any questions, please contact us, and we look forward to seeing you on the next video. Thank you.